Ladies and gentlemen, good day and welcome to Max Financial Services Limited's Q1 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amrit Singh, Chief Financial Officer, Max Financial Services Limited and Max Life Insurance Company Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and welcome to the earnings call of Max Financial Services for the quarter ended June 2023. Results have been made available on our website as well on the stock exchanges last evening. Today I'm joined by Prashant Tripathi, MD and CEO of Max Life Insurance. Let me start with the recent development on Axis Bank transaction. We would like to inform you that pursuant to the approval of Max Financial and Max Life boards, Axis Bank will be infusing rupees 1,612 crores by subscribing to equity shares of Max Life at fair market value determined basis DCF methodology. Axis Bank has already received requisite approvals from RBI for infusion of this capital into Max Life. Post subscription to the preferential issues of shares, Axis entity shall collectively hold 19.02% equity share capital of Max Life. Axis will also have an additional right to acquire 0.98% stake of Max Life from MFSL. The proposed transaction is subject to receipt of shareholders' approval and regulatory approvals from IRDAI, PFRDA and CCI. This capital infusion will help Max Life to support its future growth ambitions, and it will also help augment the capital position of Max Life, thereby improving our solvency margins. On the allotment of the said shares to Axis Bank, the shareholding held by Max Financial in Max Life will stand reduced to 80.98 from the current levels of 87%. The additional capital infusion by Axis Bank in Max Life highlights their commitment towards building a stronger franchise. With this update, I will request Prashant to share the key business developments during this quarter. Prashant, over to you.
Thank you, Amrit. Good morning, everyone. Let me just try and give you updates around the strategic areas that we call out on our presentation. Let me first begin with what we are doing in distribution. As you know, we are trying to build a predictable, sustainable growth engine by building a strong distribution network. And as a part of our ongoing effort to enhance our distribution capabilities, we successfully onboarded 6 new partners during the first quarter of FY24. Notably, we established partnership with South Indian Bank and 5 additional brokers and corporate agents. And in the following quarters, business from them will begin. We are working in a very programmed manner to expedite and enhance our presence on those counters. In quarter 1, our new business premium experienced a noteworthy 25% growth and total APE grew by 10%. Our crop channels achieved substantial growth with APE increasing by 23%. This growth was primarily driven by impressive performance in both online and offline proprietary channels. In the online space, our market leadership in protection products is maintained, and we achieved successful market share expansion in the savings business also, resulting in a 44% growth in our e-commerce business. In the offline channels, our proprietary channels demonstrated robust growth of 18%. The agency channel growth fueled by new agent activations and advisor recruitments. Furthermore, our direct channels, their growth was attributable due to the launch of new cross-sell channel and increased manpower. So overall, in both online and offline space, we saw very robust growth. However, our bank channels AP experienced a 2% decline in quarter 1. Looking ahead, we have planned series of significant investments in FY24 to bolster our proprietary channels, including the establishment of 100 new offices, among other initiatives, which have to be established this year, and we are working on that initiative already. Overall, our unwavering commitment remains to drive growth across diverse channels and reinforce our prominent position in the market. You would have seen from the July numbers, which were published yesterday, that the growth has further enhanced and the momentum has accelerated in the month of July. In the products area, to drive margins, we are continuing our journey of innovation and our commitment to offering a wide range of choices to our customers. And we are very happy that we introduced a new par design in the last quarter, which is called Swag Par. And we saw remarkable success within just 30 days of its launch. This product not only enhanced our product suite, but also brought a fresh balance to our product mix in quarter one. You would have seen that the product mix has been rebalanced more in favor of par, which was our desire. Furthermore, we have made adjustments to consumer benefits across our product categories, resulting in improved outcomes for all the stakeholders. These efforts have contributed to a reasonable expansion on year-on-year new business margin, increasing by about 110 basis points from 21.1 in the first quarter of FY23 to 22.2 in the first quarter of FY24. And thus, it has given a 16% growth to our value of new business. Breaking down the individual APE basis for FY24, our product mix comprised 20% participating, 41% non-participating savings products, 29% unit-linked insurance, and 10% protection products. Our strong belief in long-term potential protection and retirement opportunities has driven 36% growth in retail protection segment and 260% growth in the annuity segment during the first quarter of FY24. Additionally, Max Life Pension has achieved an impressive asset under management of approximately 293 crores as of June 30, 2023, and we are one of the fastest growing in terms of asset built up in the new pension fund management companies which have been set up. For the customer, which is our third element of strategy at Max Life, our unwavering commitment lies in providing our customers with significant value proposition and continuously striving to enhance their overall experience. Our best-in-class claims paid ratio of 99.51 in FY23 is a testimony to our focus towards customer obsession, and we are very proud that we have done a great job when the real moment of truth comes in the lives of our policyholders. During quarter one FY24, we also witnessed a 1-point improvement in our overall company net promoter score, which has increased from 52 in March 2023 to 53 in June 2023. Moreover, Max Life proudly maintains its position as a market leader in terms of 13th month persistency for the number of policies. In terms of number of policies for 13th month, Max Life Insurance is number one. It is number two in 25th month persistency, and it is number 3 in 61st month persistency on number of policy basis. In specific term, our 13th month persistency in terms of regular premium stood at 84%, and our 61st month persistency was at 51 for the period ending June 2023. This progress actually highlights the trust and loyalty of our policyholders for Max Life. The fourth element of our strategy, which is around digitization for efficiency and intelligence, our comprehensive digital sales transformation has been successfully integrated across all our channels. We fully launched the M-Smart Sales Management and Activity Monitoring tool for all the channels, aligning the revised processes with channel-specific metrics to drive tangible business outcomes. We are making an attempt to make our sales channels more digitized, more metricized, and we are trying to look at the choreography across all our channels, and some of the success that we are seeing, especially in our proprietary channels, are also because of the work that we have been doing towards digitizing the sales monitoring process in our prop channels. To enrich the onboarding experience, business insurance is now enabled on our onboarding systems, facilitating a fully digitized application and issuance process. Furthermore, we have expedited the onboarding journey of the national pension system by integrating permanent retirement account number, and we have introduced account aggregator as a valid surrogate for income documentation for salaried customers. In our pursuit of elevating customer service standards, we have introduced a seamless customer-driven journey through the digital living certification. Our commitment to improving services for non-resident Indians is evident through the implementation of ATCA and NEFT enablement on our website. Our continuous effort to extend coverage for auto financial underwriting within the self-employed segment, we incorporated an AI engine. This integration includes the utilization of financial surrogates derived from bureau or third-party data and account aggregators. These initiatives underscore our dedication to embracing digital transformation and harnessing cutting-edge technologies to deliver heightened experience for our valued customers, all this while enhancing operational efficiency. To summarize, we are working on successfully concluding a series of regulatory and operational steps to fructify the Axis transaction. In addition, our productive investment in proprietary channels will serve to reinforce our confidence in upcoming phase of growth. By every passing month, we have witnessed that the performance of the organization in terms of growth is increasing, and we are very optimistic as well as confident about quarter two and for the rest of the year. With this, I'm going to hand it over to Amrit, who will provide an update on our financial performance.
So moving on to the key financial metrics for quarter one. Consolidated revenue for MFSL, excluding investment income, was at rupees 4,730 crores, a growth of 19% in quarter one. Consolidated PAT stands at 101 crores, which is up 48% last year. Renewal premium for Max Life has grown by 15% to rupees 3,014 crores. Gross premium has grown by 19% to rupees 4,871 crores. Value of new business, as Prashant mentioned, for the period was at 247 crores versus 213 crores for last year, resulting a growth of 16%. The NBMs have improved to 22.2% as compared to 21.1% last year. Embedded value for Max Life as at end of 30th June 2023 stands at 16,938 crores, thereby an operating ROEV of 14%. Policyholder OPEX to GWP stands at 17.4%. Max Life's standalone profit is at rupees 103 crores, an improvement of 14%. Profit after tax is around 89 crores. The solvency ratio for Max Life stands at 188%, and AUM under management as on 30th June 2023 is 1.29 lakh crores, a growth of 21%. To conclude, we remain confident in our ability to leverage and strength and deliver sustainable value to our shareholders and customers. We also remain committed to our purpose of inspiring people to increase value of their lives. We are now happy to take any questions that you may have, and I will now hand over to the moderator to open the floor for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the first question from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Good morning, Prashant and Amrit. Great start of the year today. 2 questions. The first one is like, the change of plan, so nearly, 1,600 crore capital infusion, that kind of increases your solvency margin to nearly, say, 230%. So, I mean, in this sort, of course, this change of arrangement would have some thought process behind it. So if you can just sort of provide some color on your growth plan, say, for over the next 3-4 years, because this is a substantial, like 40% augmentation to your solvency margin. So what kind of a growth plan do you have in mind over the 3-4 years? And secondly, if I go into, the margins, of course, there have been marginal increase in protection, but overall margins continue to hold well. And in fact, it has consistently come better than what sort of a typically you have guided. So you have tried to sort of a moderate margin expectation for quite some time, but in the end, margins have come better. So I mean, what sort of a margin trajectory do you see, particularly once this Axis deal is also consummated, where of course we are mindful of the fact that the Axis is eventually paying more than what the plan said, the older plan. So all there is some kind of change in the contours of the payouts and all. So if you can provide again a medium-term guidance on the margin part. Thank you.
Good morning, Avinashji. Like always, very sharp questions. Let me address them one by one. You're right. Our solvency margin is going to go up by 39%, which will give us good capital in the business, which is required for growth. We have very aspirational plans for future, which we have been repeating again and again. We have specific plans to drive growth and, growth upwards of 20%. We have plans to become dominant in two areas, protection as well as retirement, and within that annuity. And as you know, these product categories require capital because the initial requirement of capital on both these products is higher than the savings plans. For this to happen, we do require capital as a business, and we actually raised this with our shareholders, and shareholders kindly agreed that rather than doing a secondary, this will be a primary where the capital will come to Max Life Insurance. It's really a positive step for our growth, and we are very optimistic that this capital which is coming to our business will be good for driving our growth for at least next 18 to 24 months. So that gives us good capital for growth. Coming to your second question, yes, while the margin is little higher than how it was last year, I must highlight to you that this deal has no bearing on the operational performance of the organization. We already had a very aligned view on how we want to drive business. We are working to a plan. We will continue to drive the business the way it was envisaged. And, the guidance on margin actually stays, which I gave at the beginning of the year, that we should look at margins for the full year lower than how it was last year. We have given guidance of between 27 to 28%. I also highlighted quite clearly that at least for this year, there will be bias towards driving growth as against maximizing the margin. We will, of course, be very mindful of the margin, but we are making investments in driving our prop channels. We are opening offices. We are buffering up capacity. We've deployed more people on bank assurance. We acquired many customers where we will be deploying our own people. So there's an all-round work taking place towards driving growth, and hence, the guidance on margin actually stays. Having said that, the attempt towards optimizing the margin will always be there. We will work towards, reaching the levels that is not negative or generally positive. So those will be the attempts, but for the time being, my guidance actually stays.
Yeah. So quickly, just one quick follow-up. So, of course, in the backdrop of also that March was abnormally high, this 20% kind of, the growth guidance, does it hold for this FY as well? Or because, this FY is coming from a different March base. So this 20%, of course, growth guidance medium term, I understand. For FY24, is it something different or some adjustments?
Yes. No, Avinash, you're absolutely right. This 20% growth target or growth aspiration is for medium term, which is about 3 to 4 years. However, this year is in that sense unusual because we have a very large March base. Our attempt is to hit a double-digit kind of growth rate for the year, for the full year. And by every passing month, we are getting more and more confident as the numbers improve. For this quarter, which is, the quarter which is ongoing, our target will be to hit a number which is plus 20%. We are reasonably confident we'll be able to do that.
Okay. Thank you.
Thank you.
Thank you. We'll take the next question from the line of Madhukar Ladha from Nuvama Wealth Management. Please go ahead.
Hi. Thank you for taking my question. So, just wanted to get a sense of how the access channel is doing. At least first quarter, it seemed to be little subdued. So, what are we seeing from there, and what do you think should be our expectation for this year, for the balance 9 months?
Yes, your observation is correct, and it is highlighted in our representation also that the growth from Axis channel for the quarter was subdued. It was not on account of we significantly losing counter share or anything like that. The counter itself witnessed slow growth or sluggish growth, predominantly because we were dealing with a very large base effect. as every month passes, you will witness yourself that the performance on Axis channel will start to improve. I'm very optimistic that will start to happen starting this month. So we remain optimistic. Axis contributes at this point in time anywhere between 51% to 56-57% of our sales, and it is imperative that we do well on that counter. Having said that, some of the changes that you see which have been made yesterday underscore the commitment of Axis Bank towards Max Life Insurance and its desire to drive the business up. We are very closely now working alongside the management team of Axis Bank. We have great support from them. So I remain absolutely optimistic about the growth prospects. But yes, first 3-4 months were a bit sluggish.
Right. And on the margins front, so, if you look at it on a year-over-year basis, annuity and non-par share increase in the mix has been almost about 1,100 basis points. Protection has also increased. But still, our margins have grown only about 150 basis points. I know that we expect to increase investments in these channels, in the proprietary channels. But I would have expected a slightly higher improvement in margin given such a big change in product mix. So your comments on that, yeah.
Hi, Madhukar, this is Amrit. Thanks for that question. Your observation is correct, Madhukar. I think the mix has improved and you would have expected a higher margin expansion. But there are two underlying factors which is causing this. One is the new initiatives and all the new capacity that we have been installing over the last 6 to 8 months. And given our reporting mechanism is of actual cost and absolute cost for the quarter, and the fact that this quarter is low on sales, there is a drag which that particular thing kind of creates on overall margin profile. And that's a fairly substantial drag. There is another element of the drag which is more to do with underlying variants and mixes and also the curves movement during the quarter, which has had some bearing on the margin profiles of each of the categories. But we have taken pricing actions around correcting some of these things, and that will get corrected. And with respect to OPEX, some part of that drag will remain, and that's also the reason for us guiding a lower margin profile. But as the year matures and sales volume picks up, the operating leverage will play out.
Got it. Thank you for the answers and all the best.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hey, hi Amrit and hi Prashant. Just firstly on this non-par bit, what is the kind of pricing action that you just alluded to that you would have taken with what kind of action you would have taken in this quarter or in 2Q so far? And also would like to understand on the same, continuing on the non-par piece, as to what is the kind of demand on the ground and the category of 5 lakh plus. How has that changed in the new tax regime? That would be my first question.
Hi, Prash. How are you doing? On your second question, there is no impact that we have seen so far with respect to the mix of greater than 5 lakh business, the traditional business which was impacted by tax regulations. That mix has remained largely similar to how it was last year in the same quarter. Though these bases are smaller, but on that small base right now we haven't really seen any impact coming through which is material. Coming to the actions that we have taken on non-par, these are generally reduction in IRR of the products which are in line with how the interest curves move. So these actions are on those lines where we have been correcting over the past now a few months actually, progressively the IRR making it more in alignment with interest rate movements.
Yeah. And the other question was on the banca channel again, while you mentioned that you haven't lost any share on the Axis Bank front. But how are the other banks, kind of your other partners performing, and how do you kind of see the ramp up from the banker channel going ahead? And I'll just slip in one more, is on the protection bit, wherein, what's kind of driving the retail protection demand, and what kind of growth do you envisage for the full year?
All right, I'll take that. On the banker front, there are our two largest counters saw open architecture over last 12 months or 12 to 15 months. Mathematically speaking, that's why you saw our growth being impacted. But in both our counters, large counters, Axis Bank and Yes Bank, the open architecture has stabilized. The number of players who had to come on the counter have come. And, hopefully from here on, the growth that the bank will achieve, I think we'll be able to mirror the growth. So, we will witness good growth. So it won't happen that the bank grows and we don't grow because open architecture has settled, which is in a way very positive thing. But of course, it was a painful process over last 12 to 15 months that we had to go through. We are acquiring new banks, and I'm very optimistic about it. So far, we have signed up 5 small to medium sized banks over last 7 to 8 months. Tamil Nadu Mercantile Bank, Ujjivan Small Finance Bank. We signed up with BCB, we have signed with Capital SFB, and we have signed up with South Indian Bank. And on 2 of the counters, we have already started to work. We are seeing reasonable traction, though the sizes are small. But I think these are relationships for future, and as every quarter passes, we will have more and more share coming on them. So I remain quite optimistic about our ability to grow. At the same time, we also signed up with 10 of the largest brokers, 2 or 3 large corporate agents. There's big effort which is taking place towards securing more and more counters, and hopefully through all of them, we will start to witness growth come through. So I think my narrative will be the tough phase on banca seems to be coming to an end, and I think with the momentum that we are seeing on proprietary channel with our banks firing, I think Max Life Insurance performance on new sales will continuously improve. On your question on protection, we saw 36% growth. This is better than how we were expecting at the beginning of the year. And it has 2 reasons to it. I think the biggest reason is base. During COVID, before COVID, that entire phase, we saw good demand from customers, and that was being driven by the pandemic. Once the pandemic got over, that demand stabilized for a couple of years. But starting this year, we started to see that the demand has picked up. The search queries have gone up. The more and more number of people are coming, trying to buying protection. So that's the demand side. Also on supply side, we worked on buffering of capacity in underwriting, looking at which segments we want to work on, renegotiating and onboarding a new reinsurance partner. Some of the flexibilities that we were seeking are available in terms of the sum assured that we can offer, the type of customers we could go to, the number of cities that we could go to, all that starting to help. So there has been work on demand side or improvement on demand side as well as on supply side. As a result of this, it has picked up, and it's not just Max Life. We are seeing that across all industry, our brokers, etc. So overall good news, and we are a prominent player in terms of the penetration. We are number 1 as a percentage of sales. We are number 1, and I'm quite optimistic that this growth trajectory will continue to remain high as we traverse through the year.
Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the opportunity. I have one simple basic question. Why Axis has stopped at 19 instead of 20? Why that optionality of not taking up to 20 in one go? Any reason to understand that point? Why 1% of left over? That's my first question. And then I have 2 questions on the operational side. Maybe I'll ask afterwards.
I think the reason for that is the approval that was sought and the volume that was sought of 612 crores, and honestly, whatever is the valuation that has come, so it's a mathematical outcome. So there was no intentional effort actually to keep it at 19 and not 20. So it was dependent on the valuation, and the valuation has come to whatever 113 rupees, because of which the reverse solve is about 7%.
Got it.
So that's what they are going to take. The objective definitely is to go up to 20 as soon as possible. So we will move in sequence, and there is no agenda here, honestly.
Got it. And so this 1% will be more, the residual 1% will be more like a primary again, or it most likely will be a secondary one?
It is expected to be secondary, not primary.
Okay, perfect. And second question is regarding the opportunity size, or you internally might have assessed these new relationships, South Indian Bank, DCB, UG1, or Tamil Nadu Mercantile Bank, and new broker relationships, what you have got into. Means internally you might have assessed what this size in AP terms could be for you. So just wanted to understand, potentially, if it plays out as per your plan, how much these relationships can contribute to your top line, and given these all channels are open architecture channels. So just wanted to understand the delta, what you can expect coming from new relationships.
So these are strategic relationships, and they built over a period of time. So honestly, I'm not giving any huge forecast about this year in terms of how much sales they will deliver. Of course, the sales will be moderate this year, but I'm very optimistic that these are strategic partnerships and they will build over a period of time. So next 3 to 4 years, all the new accounts, new banks, new brokers, new corporate agents that we're signing up, we will try to hit a 4-digit number in terms of sales coming from them every year.
Okay. So in 3 years, I can expect it to be closer to 4%. That's the way I should understand.
So
okay.
4 years time.
Okay.
Close to 6-7%, my sense.
Okay. Got it. And the last one is on two data keeping questions. One on that AP on EV. How much of economic variance contributed to the 20% growth? That's point number one. What is the economic variance number sitting in the EV part? And second, on annuity part, the growth is very extraordinary. So we just wanted to understand, this is more driven by individual business or group business, and do you think that number is sustainable? Because if it is led by group, how lumpy it is in the current quarter?
So on non-operating variance in the EV, I think that was your first question. That's around 133 crores.
Economic variance, Amrit, sorry.
Yeah, that's largely economic variance only, 133 crores.
Oh, okay. And on annuity?
Annuity, so look, I think we have established a full retirement machinery, which actually entails us now tapping into corporates, tapping into retail individuals, tapping into national pension system ecosystem. And we use product chassis of individual annuities and group annuities. So though the growth, as from a categorization perspective, is driven by group annuities, but the reality is that it is actually very granular. Even in a corporate annuity kind of a program, you have to go and meet that individual or influence that individual who's retiring and whose superannuation corpus is now becoming available for annuity to be sold. So I would actually advise you to look at annuity collectively rather than segregating it into individual and group, because it is not, that lumpy in its nature, because of the way we have kind of orchestrated ourselves. There will be certain deals which will come our way once in a while, which would be large in its size and ticket, but that's largely it.
The reason I was asking this question, Amrit, was that if it is more group annuity, typically the product what you will be selling will be immediate annuity, which I believe will have a lower margin profile compared to a deferred one. So just wanted to understand, this group annuity is what you do is better than the company average, or maybe at par or lower than the company average?
So it is, the margin profile is slightly lower, you are right. But I mean, it's actually, there's a need for the consumer. Various different tools are available to sell for it. At the end of it, such a strong growth of 260% in AP that we have demonstrated is all VNB accretive, and Anyways, this profile is also margin accretive.
Got it. Thank you. Thanks. That's it from my side.
Thank you. The next question is from the line of Adarsh from CLSA. Please go ahead.
Yeah. Hi, Prashant and Amrit. The question is on when you look through this particular deal, right, that Axis has got more control in terms of appointing board members. Now, how should would you as management now be very comfortable with the fact that market's been thinking of wallet share losses further because you have more partnerships in Axis? So does this make you feel very comfortable about wallet share now in Axis counters?
Adarsh, thank you very much and very good morning to you. I think as management, we've been repeating multiple times that we have been very comfortable with Axis Bank and how our counter share position will be. I've repeated multiple times that everybody should expect us more in the range of between 65 to 70% or 70% plus minus a few points. So with this change, actually, it's not an additional comfort to management. I think it is an additional comfort to investors and analyst community because we always knew about it. But yes, you're right. With these changes, which are quite positive in nature, I think Max Life Insurance is set up for growth, is set up for higher collaboration and better guidance and alignment with Axis Bank and its top leadership.
And one more thing, I think somebody asked, but I don't know if it was unanswered, was any change in economics, except because when we were crying about this deal of giving a stake for a longer banker partnership, it didn't involve, at least to start with, a payout of so much by Axis, right? So could there be any changes in payout which could affect margins for Max Financials over a 2-3 year period? Do you envisage that?
In the context of what we are trying to build together and what Axis Bank is going to participate in, these amounts are not quite material. And this is a strategic investment for Axis Bank in Max Life Insurance. So the answer to your question is no. We will continue as it is, and we will try to do the best that we can. The value creation opportunity in this space, where we are indeed scratching the surface and the franchise is really good, Axis Bank saw value in coming at the fair market value as against the discount that they were getting.
Got it. And my last question is on protection, Prashant. You did mention part of the growth is aided by the base effect, right? Like post-COVID things have been slow. Just wanted to understand now in terms of how underwriters or reinsurers are looking at it. Do you get a sense that their thresholds of what they want to clear and underwrite, are that changing, or just that people are getting used to higher threshold of what will pass as a file or something of that sort?
I think as a country, and not specifically COVID example, as a country, the experience has evolved, and I think there's high level of alignment and understanding between the three constituents, the reinsurers, the life insurers, as well as customers. So the prices have increased in general. We have understood what kind of profile or mortality profile is going to come forward, and that has given a lot of comfort to reinsurers also. So they have been loosening. I have noticed that on certain elements they have loosened, and it's others finally a trade-off between price and flexibility. So I will say better situation, better understanding, and that will go a long way in terms of driving growth for all the constituents.
Perfect, Prashant. That's it, and thanks and congrats on all the developments.
All the best.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may press star and 1 now. We'll take the next question from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Hi, thanks for taking my question. The first one is, essentially on, your outlook on the non-par business. Given the fact that you have repriced the product now, do you expect the momentum to continue? And hence, do we expect the non-par share to remain at similar levels towards the end of the year?
Thank you, Nishin. That's a great question. I mean, when we finished last year, of course, the bias towards non-par was higher, and we have made conscious efforts this year actually to rebalance. And many times the product mix also gets driven by the product of the season. So, for example, last quarter we launched a product which was more in par space, and of course par gained ground. As we are moving through this quarter, we have a very strong ULIP plan as well as a non-par plan which are scheduled to be launched. But on a long-term basis, Nishint, we will attempt to be closer to 40%. That's our attempt. In terms of acceptance, this year the stock markets ran, so there is higher acceptance towards ULIP, but the category remains quite strong and it has value. So I'm not expecting that the demand for non-par is going to dwindle or the share will go down. We will try to be closer to 40%.
Question in different words. When we look at the VNB kind of bridge at the end of the year, would you have sort of a negative in the business mix line item?
If you could clarify what the question is, Nishint.
No, I mean to say that, when we are looking at the VNB at the end of the year, and you have kind of given the guidance for, kind of some compression in margins, then would you see the new business line item, the business mix line item contributing to it, or is it, anything else?
No, it will be new business line, of course.
No, I think, Nishint, your question is that will mix cause margin shrinkage?
That's
what I was trying to say, yes. Excluding, investments and overruns.
It will. Because non-par proportion of last year was quite high given what happened in the last quarter, and also quarter 3 when we had a product launch around the non-par side. We will like to keep the non-par steady around 35% kind of levels for the year, 30-35% levels for the year, whereas it was upwards of 40% plus last year. This is non-par savings, but protection and annuity are in addition to that. So, but from a shrinkage perspective of margin profile, there will be a mix and there will be cost both.
Question is on your counter share in Axis Bank. The other bank assurance partner mentioned high single-digit growth at Axis Bank. So, and I think we are in sort of flattish to minus 1 or minus 2. So, is it something that there was a change in counter share during the quarter, and how do we read on this?
So it goes up or down actually, Nishint. There was a particular month where we lost a bit of counter, but we regained. So, like I mentioned to you, we should remain range bound between 70 plus minus 2. That's the kind of number, and we are in that range. So there will be months where you will see other partner growing more than the bank. There will be months where you will see we growing more than the bank counter. Those possibilities do exist, but we are in range in the range.
That's my question. Thank you very much and all the best.
Thank you, Nishint.
Thank you. The next question is from the line of Neeraj Toshniwal from UBS India. Please go ahead.
Okay, hi. Wanted to understand, is there any change in strategy towards credit life? Because it seems to be doing very well this quarter.
Yeah, of course, we are trying to acquire new partners. There's reasonably high level of aggression as well as growth, and more counters have been won. Like I always mention, the level of flexibility to drive the business in the context of changed guidelines and regulatory flexibilities have enhanced our ability as well as desire to be significant or reasonably significant players in this space. So we are pursuing this agenda reasonably aggressively at this point, Neeraj.
Got it. And what kind of run rate we can expect? Similar run rate we can assume for the coming quarters, or we may be more?
Yeah, you should see growth. You should see robust growth come through.
So we grew 29% in this category in the quarter, and you should see further acceleration to this number.
Got it. And second would be on ULIP. I think against the industry where peers have been phenomenally well in ULIP, I think we are indeed, because of probably a higher base, it's looking a little weaker. So what is our strategy? It's a conscious strategy to be lower in terms of ULIP, or we may see pickup here happening?
No, you will see pickup in this quarter actually. Like I mentioned to you earlier in my discussion, that we are launching a new ULIP design. we are going to launch it, and it will be present on e-commerce space, on the banker space, as well as agency. However, we are not going to open it to just about everybody. We will be very selective about it, and it will be given to people who are capable of selling. So the presence will be more on with perhaps bank RMs, with our top agents, on perhaps the policy bazaar counters. So those are areas where we'll open ULIP selectively. But you should see ULIP proportion increase as well as having its impact on our growth.
Got it. One more question is on the resources. How many people we have deployed at Axis Bank before the loss of wallet share, and now how many resources would be there? If we can share that data.
So rather than giving you a number of resources, let me say percentage. We are 26% higher than last first quarter to this first quarter.
Okay. And last question is on the timeline of the deal. When can we expect this deal to close, and any further plans and further update to Anujeet exit which may happen? Because now if Axis would be in control, what is the rationale of him being on the board, or will he continue on the board? How do we think about it?
So, on your first question around timelines, the timelines that we are envisaging is anywhere between 3 to 6 months. This entails, we do intend to share out a postal ballot for the shareholders to approve, and in parallel also reach out to the regulators. This will require IRDI and now PFRDI as well, because we have a pension fund subsidiary where we are the sponsors, and any change there also requires their approval. Of the sponsor requires their approval, and a CCI nod as well. So we are anticipating a time horizon between 3 to 6 months to conclude and complete this. With respect to Anujeet Singh, who has been the founder, chairman of this company, and then has built the franchise, he continues to be the chairman until we indicate.
Got it. Thank you so much, and all the best.
Thank you. The next question is from the line of Prithviraj Saya from Agam Capital. Please go ahead.
Hi, I wanted to ask, in the NPS, in the annuity business, I wanted to understand where NPS stands. Maybe currently it's not very meaningful, but in the larger scheme of things, how do you expect this to, contribute to the annuity business?
As I indicated to you, we have now created a holistic retirement team, which actually is tapping into all the three ecosystems: the corporate annuity market, the individual annuity market, and also being present in the national pension system annuity market. National pension system is, there are maturing customers, and obviously that maturing profile will only keep building up as time kind of goes by. You know that this ecosystem was set up in 2004, and some bit of those retirees have started hitting in. Now we are quite present with respect to our presence. We are actually contributing, but is it right now very meaningful? It's not very meaningful at the moment, but definitely we expect this to become bigger and larger as time progresses.
Okay, thank you. Another one on the state insurance, wherein you were allotted a couple of states as a lead insurer. Can you quantify what will be the impact we can expect from this in terms of business?
It is a bit premature actually to talk about the volume numbers, but we remain very optimistic and we are going to participate. There are two states. The largest of them is Uttar Pradesh, which has been allocated to us. We are right now putting the plans in place, deploying resources, and the big vehicles through which we will approach state insurance plan will be Bima Vistar as well as PMJJBY. So those are two products that we'll be driving.
Okay, thank you.
Thank you. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Hi, thank you for the opportunity. I have a question on the new product, the Swag Par product that you have launched. So back in third quarter 22 also you had launched a new par product which did quite well. And as far as I remember, that was also a higher margin and probably a longer term product is what I remember. So can you give some color about what is the color about the product? And also with these two new products, can we now say that your par book is effectively no longer the 10 to 12% margin book, it's a higher margin book, in case if Swag is also a higher margin product?
So, we did launch this product in the month of June, Swag Par, and as was mentioned in the opening remarks, this product has done exceedingly well in its launch period and continuing until now. This product has very similar to the principles of the non-par Swag product that we had launched in quarter 3 of last financial year, has many flexibility options with respect to payment terms, policy terms, income period starting, income bonus elements and guaranteed portion of the bonus elements, etc. So it's a very comprehensive and a holistic product which has been very well accepted by both customers and distributors from our perspective. And has definitely augmented the par portfolio which Max Life has been known for in the industry. Is the margin profile of this product profile better? Yes, it is better. It is better than the traditional par products that we have been running.
So fair to say that in the future, majority of your par book will have more non-traditional par policies which have a better margin profile, right?
It will. I mean, there is obviously other par designs also which continue to sell, but par portfolio should improve at an aggregate basis on margins. Yeah.
Okay. Thank you.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity again. Just a question on a couple of regulations. Firstly, on the expense of management regulations, do you see any changes in the commission payouts, and what are your thoughts and strategies to kind of implement this regulation or take advantage of this regulation? Secondly, on IFRS implementation, there is talks about few of the insurance companies moving to IFRS from, if I'm not wrong, from FY25 onwards. What are your thoughts, and how is your preparedness, and what would be the implications on the numbers as and when it is implemented?
First question was?
Expense of management.
Expense of management. Yeah.
The expense of management actually it creates more flexibility. Rather than looking at commissions, it focuses on overall company expenses. So there may be change of colors in terms of how we recognize expenses. However, at a total expense level of what we were incurring as expenses, I'm not expecting any change to our expense profile, which means at a total commercial level, we are not going to incur any additional expenses. However, there will be reclasses which are possibilities. On IFRS, we are one of the chosen companies, and we are working, I think, with Deloitte, KPMG, as our partner to be prepared. There's a core team which is working on it. There's a lot of push from the regulator to move to IFRS as soon as possible. We are one of the chosen companies model companies who have to go in the first tranche of implementation, and we're very optimistic we'll be able to conclude it as time progresses.
Great. Thank you.
Thank you. The next question is from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thanks for the opportunity again. The last one I have is that after this 6 months, the timeline for the current Axis stake increase approval, when you will start that reverse merger process, and expected timeline, probably given you will need to take multiple approvals there also, how much timeline you believe will take for the entire thing to collapse and Max Life to become the listed entity?
So one step at a time is what I will say. Right now, the entire focus and attention is going to be to consummate this 7% and subsequently the 1%. Once all that is done, we'll initiate the process of doing it. I think that will be a longer process. So assuming that we are able to do this transaction over 6 to 9 months, you should expect a further period of about 18, 20 to 24 months to do that.
Got it. Perfect. So basically, it's from, if I add up all the numbers, all the months, maybe it's a 2.5 year kind of a scenario to everything to consume it, right?
You're right.
Okay. Perfect. That's it from my side. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you.
Thank you, Michelle. And thank you, ladies and gentlemen, for being on our call. We look forward to more such interactions in future. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Max Financial Services Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.